it did. It's basically back at the not even up at the upper end of this recent last 2-month range, which is around 1100 on the upside.
By the way, Asia's deep in the red. The Japanese index is down 2.8%. Kospi is down over 3%. Hang Seng is down over 2%. So Asian markets is sinking as Trump has proposed an additional 10% on China, which means imports from China will now attract a duty of 20%. And 4th of March it is for imports from Canada, 25% import duty on Canada and Mexico. So it's rattled sentiment in Asia.
All right, well, first rate starting to come up on our screens, 0.5% lower on the Nifty, 22,400. The Nifty Bank is about 1% lower, 48,300 on the Nifty Bank. So all of yesterday is 0.5% plus kind of gain being given back. The IT index is down 1.25%. 3:1 in favor of declines. That's the market breadth straight out of the gates. But I think we should give it an hour more, 2 hours more. Actually, an hour is enough, and we'll see if this starts to change or maybe look a little better. But now it's all deep in the red. Look at the Nifty heat map. It's running out. It's at least the start this Friday morning is pretty poor. Got 2 names in the green now left within the first 60 seconds of market open, and everything else is down and out. Mid and small cap indices starting with about 1.5% cuts this Friday. Rima.
Mid-cap index down 1.5%. Small-cap index is down also 1.5%. And now the week-to-date losses for the mid-cap index stands at in excess of 3.5%, while the small-cap index is lower for 4.5% so far this week. So broader markets underperforming yet again for the 5th day in a row, and losses now for the 5th consecutive session. The mid-cap, the Nifty and the Sensex too are sinking lower, now down 1% on the benchmark indices. The Nifty is down 200 points. The Nifty's breached 22,350. So it's quite a fall that you can see on the benchmark indices. The GIFT Nifty was suggesting a fall of 150 points. The opening has turned out to be deeper, 220 points down now. Top losers include an innocent bank. So banks are under pressure. Yesterday they were resilient, but the Nifty Bank is down 500 points. Innocent Bank is weak in trade. Pull up an HDFC Bank and an ICICI Bank. HDFC Bank is down 0.5%. ICICI Bank down 0.5%. But you can see the Nifty Bank itself down close to about 1%. M&M is weak in trade. Tata Steel, JSW Steel, the entire metal complex is weak in trade. IT is under pressure. Wipro, HCL Tech staring at losses of 1.5%. NTPC is another loser. Hardly just 2 stocks out of the Nifty complex in the green. One of them is Coal India on the back of the subsidiary price hikes. That's up 2.5%. And the second one is Shriram Finance, which has been strong this week. Shriram Finance has a gain of 4% this week. It was higher yesterday, and it's managed to hold on to those gains. So in the green for now, but other than that, it's all red.
Well, that's right. Shriram Finance actually has been a big outperformer. Valuations had come to those levels where a lot of sell-side analysts had written about it at around that 530 level odd. And that's actually outperformed in the last 1 month or so. Besides that, looking at a couple of more stocks, Coal India, that one is firing away, up close to around 3%. So the street clearly likes this, 300 rupee price hike. And also they're a little bit optimistic that this is only for around 18%. Can they do this for a couple of more subsidiaries? Well, that'll be even better news. So Coal India, that's the stock that's doing very, very well. From the broader markets, another stock that's doing well is Transrail Lighting. Why is that? They have won new orders worth around 2,750 crores. At least the first tick was in the green. I'm not sure whether it's still holding. It's still up close to around 2%. So good on them. Good move is what we're seeing out there. IRDA, it's welcome to the F&O trading with the 5% downtick. Stock has already corrected. It's half actually from the top. IRDA, that stock in fact is down close to around 5%. NTPC Green as well as down close to around 4%. Let's pull up Premier Energies for the last many trading sessions, irrespective of what's happening fundamentally. The street has been very, very nervous about, this lock-in getting opened out. And that's what's happened today. So for the time being, it's down close to around 4%. The markets continue to remain under pressure, down 220 points or thereabouts. The Nifty Bank is down 450 points.
All right. No, absolutely. 220 points lower on the Nifty is what you have, 22,300. And this is, as poor open as, we've got lately. So it's a full 1% cut now coming through in sharp focus, sharp contrast. I can go through many more names here which are down. That's easy to do. It's 10:1. 10:1 declines to advances at this point in time. And I'm just spotting any big outlier kind of moves, anything which is managing to kind of sort of, come through aggressively on the other side. There isn't any, actually. There isn't any at all. Maybe KSB, is it KSB pumps? I'm not sure, but that's a 6% gain. There is something like a Sanofi, which is up about 5%. And, Transrail is up about 2%. That's it. I mean, if you keep a 2% cutoff, there are these three names which come up. And maybe RR Kabil as well, which is up about 2% on the other side. So those are easier to spot in what is otherwise the absolute sea of red coming through. So that's the overall picture.
KSP is actually the results game, I think so. It's a calendar year ended. So out there you had the revenues that were up by around 21%. Gross margins came in at around 43%. And the EBITDA number as well was up by 22%. So I guess that's the reason that the stock is up.
All right, standing out, shining, otherwise sort of tough kind of open. Rana Gupta, is Senior Portfolio Manager, India Equity Specialist at Manulife Investment Management. Rana, good morning. Great to have you with us here on the program. Appreciate it. Prashant this side. It's getting worse and worse. And, at some point, it will turn. But Delhi kitti dur hai, Rana? That is essentially what people want to know. Are we in for a lot more price damage, time correction? What's your view?
Good morning. Glad to be on your show. Although, the markets are all red and it is easy to be, quite pessimistic about the markets. But I think let's put this fall into some context. The correction really started from October, and since then, markets down about 15%, broader market more than 20%. This includes earning cut over 5-7% and P correction about 10%. What we are seeing is now that even on the cut EPS, markets have reverted to average valuation, and India's premium to the emerging markets is almost dissipated. It's just a little bit of it left as compared to what it used to trade at. So valuation is average, valuation excesses have gone. So now the growth needs to pick up. With respect to growth, we think that as far as the domestic policymakers are concerned, through tax cut, RBI's measures, through liquidity and otherwise, they're trying to revive growth. But all this is for now not effective due to the bad sentiment and the FPI outflows. Once the FPI outflow stabilizes, I think you will see some of these measures kind of filtering through the system and some sort of stabilization. We think that because the Nifty is at average valuation, price damage has happened, while the confluence of positive that is building up, like policy intervention or a bit of a better recovery in rural, is not getting noticed today. But at the same time, coming out of this will take time. Patience will be required because of global uncertainty and the flows need to stabilize.
So till then, as we navigate through these tough times, what are you doing with your portfolio? As money comes in, where are you deploying it? Or are you sitting on cash right now? And when might, the sentiment in the market turn?
Sure, I think that we have in the view that although the market may stabilize, it will take some time. Market may stabilize before consolidates here, before any advances. But one thing we have been clear for some time that even when the market bleeding stops and it recovers, the sectors that could lead the market up will be different than what the last bull market has happened. In the last bull market, we saw remarkable results and stock performance from industrials, PSU and utilities companies. I think that is going to change. And we think that next bull market, or whenever the market upturn resumes, it will be led by mostly consumer and financial stocks. Even within financials, we like the non-banking financials more than most of the banks.
Okay, all right. So you're looking at the NBFCs?
That's right.
I guess cost of borrowing as well will come down with these rate cuts, and the valuation wise as well, they had come to pretty attractive levels. The other space, Rana, that you liked is the EMS space. I think we briefly spoke about it in the past.
Correct.
You were looking at some rural themes as well. So if you could give us the top two themes that you're looking at. The EMS space, by the way, has seen a big correction from the peak. Though in the longer term, runway is still there, and they have a lot of growth that's ahead of them. The problem was valuations, which have now corrected. Will you be positive at this particular juncture?
Sure. To be clear, in the EMS, we are bullish on the EMS ancillaries, may not be the stocks that are leading in market cap, somewhat low in market cap. The ancillary EMS is the space that we like. Nonetheless, they have also seen quite a bit of correction, and you are right. I think the long-term runway remains very good. The valuation has corrected. To be fair, I think there has been some project delays as well. But I think going forward, we expect to see a lot of policy response to let the EMS growth resume again. So that is something that we continue to like. In terms of rural, I think after a long time, we are seeing some signs of life in the rural economy. And I think that can be best played through something like a tractor companies, and also the non-bank financial companies, which is exposure to rural segments, particularly in the secured segment. That is also one segment that we like.
Can you just explain that to us, Rana, with regard to the EMS ancillaries? What all comes under that category?
If you think of, let's say, all electronic items, whether it's a mobile phone or your TV or your AC, these are all made of some components, right? So, and you require machining, tooling, CNC machines to make those. So that is the value chain that we like, because if India is going to produce all this internally, a lot of machinery requirement will be there. So that is so companies which are setting up scale to produce this, or the machine that is required to produce this, is one segment that we like.
Got that. So, Rana, the basic broader question is some of the high-flying sectors like EMS you spoke about, defense, manufacturing, industrials. When there was a lot of money coming in, valuations, I guess, were jacked up to extremely high levels. But they are still high. The question, though, is that the new, have we entered a new normal where 50 times, 55 times for companies, without naming, I can, is the new normal? Because valuations actually have been high for almost 10 years now, 10 plus years. They had gone to 70, 80 times. Now they're back at 50, 55 times. What is your sense, Rana? Or you think that will depend on where interest rates head?
I think on valuation, if you go into sector and stock specific levels, it's very clear that Indian markets rewards the companies that can show earning growth. In general, also, if you take a step back and look at the flows into the market, particularly from the FPIs, it has happened either when the valuation was low, less than 2020 when COVID correction happened, or something like 2023 when the earning momentum was very high. So I think broader point is, even if you go to the sector level, the companies which can deliver earnings, they will be rewarded, and the valuation tends to overextend, and when the earning growth cracks, valuation reverses. I think so. Getting the earning growth right will be the main thing. I think the companies which can maintain good earning growth much ahead of the industry, they will continue to trade at premium valuation, and the companies which cannot maintain the earning growth will suffer valuation correction. So I think for us, getting the earning growth right within the segments that we like are very important.
So for companies, say, growing at 30, 35%, what's the right PE multiple, Rana, in your opinion? That's the top end of the growth. That's the top end of the growth companies, right? So what should be?
Yeah. Sure. No, of course. It will be not, in my view, it will not be right to look at like just a 1 year growth, because when you talk about valuation is about the durability and the sustainability of the growth and how much of cash flows are coming. So 30% growth is fine, but the 30% growth can continue for how long? For example, let's say if you are putting, for example, instance of 50 PE on FY27 based on 30% earning growth, and in FY28, the earning growth dropped to 15 or 20%. I think in that case, one is kind of pretty much sure to make losses. The idea is that whether 30% growth continues for some period of time or not, so that when you exit, even then the growth rate is also quite high. So that is very important, and that is why one has to get into areas which are, relatively speaking, underpenetrated, or the growth runway is very long.
So Rana, what about cables and wires? Now, most of the companies there are likely to grow according to estimates by 15 to 20% over the next 2 to 3 years. So there is growth. But the problem is, after 3 years, once Ultratech Cement comes into the market with its product, so what should one do with stocks in the cables and wires segment? Were you buyers in the first place, and now what are you doing?
See, cables and wires is one segment that we liked because of the companies here are, they're all financial ratios, whether it's earning, whether it's margins, whether it is, growth, ROE, all look good. This industry looked good because, again, talking to what I was just saying, durability of growth, right? So power transmission when it happens, and because of renewable power investment, a lot of power transmission projects will happen. So within wire and cables, we like the cable side quite a bit, although cable side is a B2B business, but I think the growth runway is long. Now, if some company can top up the cable business with some high margin wire businesses, I think that was quite a good growth combination. That said, we are watching Ultratech's entry into this segment, but their entry is at least 2 to 3 years away, and our own sense is that in 2 to 3 years this industry will grow by 14-15% to accommodate a player like Ultratech, given the kind of capital outlay they have said. However, what we do not know today is that Ultratech, when they come in, will they stop at this kind of 2,000 crore investment, 10,000 crore top line, or whether they want to go more for it. So I think this is one emerging sign that you have to monitor across the mid-cap space. Wherever the mid-cap companies have been really profitable, we are seeing the large conglomerates are entering. You can think about even the cola businesses, right? Where it's now almost large cap company, but where the companies have done very well, the mid cap companies became large cap companies. There, the giants are now entering. So when we look at mid cap stocks, we have to be quite conscious about what kind of competitive threats that they will see going forward. Because at the end of the day, going forward, that can increase competition, and we have to also be very careful about the growth aspiration of the top rank, the new entrants.
Thank you, Rana, for your conversation. It was a pleasure chatting with you, and look forward to the next one. Enjoy the rest of the day. We'll focus now on the consumption space now. Rana Gupta, Managing Director and CEO at Marico, says the worst is over, but urban consumption has been stressed. My colleague Manglam caught up with Rana Gupta and began the conversation by asking about the growth trajectory for the company.
If you look at the total environment, over the last couple of quarters, rural is improving. Urban consumption has been stressed. Having said that, we believe that the worst is over. It will gradually improve. Obviously, the improvement will not be, like a hockey stick kind of a U-turn, but it will improve definitely. Now, I think as far as Marico is concerned, 2-3 things I would say was slightly different. One is, of course, our significant focus on our diversification and transformation of our portfolio to make it future ready. If you look at around 2020, the composition of food plus digital plus premium personal care was around 6%. Today it's 21%. So that is giving us that growth. The second thing is that we have been also not been cutting A&P to manage margins, but doing a far more institutionalized cost management program. Thirdly, some of the issues in the system we called out pretty early. For example, things like GT being under stress, the fact that there is a potential channel conflict, investing ahead of the curve in new channels, and of course the fact that if FMCG companies don't actively participate in the D2C space, they are likely to get squeezed out at the top of the pyramid. So I think some of the things we have taken proactive steps, and therefore that has resulted in that we are still being resilient in this situation.
So 6% volume growth is what you reported this time around. How far are you from the 10% mark? Because it's a function of what you're doing, and it's a function of what the environment is doing as well. Rural you called out as improving. Urban may not be hockey stick. What does the very near future and medium term look like for you?
So I think it's very difficult to say when will 10% happen. I think the question is that we have, if you look at sequential quarter, we moved from 2, 3, 4, 5, 6. That's been the kind of a movement. I think a mid-single digit is something which is eminently possible. Our endeavor will be to gradually move that to high single digit. I think 10 is something which again is something which will depend on the environment and other factors, but as of now I think our aspiration is how do we inch this up a little bit. I think what we are more confident about is, given there is a bit of a pricing equation that is there, to deliver double digit revenue growth quarter after quarter over the next couple of quarters, and that's something which we are pretty confident about. Our endeavor obviously will be to continuously try and deliver top quartile volume growth.
What about the margins? Because your anticipation was 20.5%. You fell short of that by about 150 basis points. That was largely on account of the sharper than expected inflation that we saw. Where do we see that going?
So I think the inflation cycle will continue for the next 2 quarters. Okay, so as far as the copra is concerned, we are broadly at the fag end of this inflation cycle. It's usually 18-month cycle. We expect things to improve sometime towards the end of quarter 1. So obviously there will be a lag and things will start improving from quarter 2. As you know, in edible oil, there's been a 20% duty, which is something which obviously has resulted in some kind of an inflation. I think as far as margins are concerned, there will be a situation where the first 2 quarters will continue to have some impact, but it will start easing off towards the second half of the year.
So how much lower can they go before they go back to that 20% mark?
I think we are in that zone right now. I don't think there will be a significant squeeze beyond this. But having said that, I think our endeavor will be to move it to 20 as we,
But then you'll have the leverage coming in from all your new brands, etc., where they are improving their operational parameters as well, right? So would there be significant growth in margins beyond that 20% mark, or you believe in, passing on the benefit to the consumers and hold your margins around that 20% mark?
So I think value to the consumers is important because we have taken some significant price increases. Similarly, as far as the digital and the new business is concerned, obviously our endeavor is to continuously improve margins. So to give you an example, if I look at the oats plus masala oats business, which is core of the current food business, that delivers an EBITDA close to the company EBITDA. Okay, I think I would say there will be 2 milestones. One, can we get the digital business, which is a very high growth business, to get into a double-digit EBITDA? Beardo is already delivering that. Plix is positive. There is a bit of a cash burn in terms of the other 2, which is True Elements and Just Herbs, but it's minor. It's not major. And so I think as long as, and we are much more comfortable with say a 30% growth with continuous improvement in profits versus delivering a 50%, 60% growth with a high cash burn model. Okay, food is also improving. So I think the margins will creep up. And I think even in our international business, there are opportunities for scale-driven margins. But as you see, we are in emerging markets. When we operate right through, in our international business and India and emerging markets, India, and the focus is to invest to grow. It is about getting new consumers. It is about getting existing consumers to consume more, grab market share, and continuously diversify.
One thing that stands out is that in all the traditional FMCG companies, you've been among the first few to get onto this D2C acquisition bandwagon. So 5-6 years into this acquisition bandwagon, if I had to ask you a couple of questions, what is it that you learned from them and what is it that you taught to them? And as a result of which the synergies were created, how would you reflect upon that?
I think 3 things. One is digital marketing. I think something which we have really learned and tried to improve our capability in that. The second thing is high velocity innovation, risk taking, and ability to gather insights from the environment and quickly launch. So it's about think big, start small.
Could you give me specific examples?
I think if I look at the innovation cycle compared to a traditional FMCG company versus say some of these D2C companies, it's severely crunched. They are happy to take small bets and risks because the risk appetite, I would say the risk appetite is high, but I think the value at risk is always low. I think what they have learned from us, I think, is cost management, governance. I think also a little bit of framework for choice making, because unfortunately in some of these companies, I'm not talking of our companies, but we have seen some of the startups, it's about spray and pray.
Yeah.
I think that ability to do sharper choice making without analysis paralysis,
right,
and something which they have learned from us.
And what about the threats? What do you think would be the potential
threats? I think the 2-3 threats obviously is that core slowing down. I think whenever there is significant pricing interventions, and if I look at volatility of raw material, commodity, and therefore we are actively ensuring that we de-risk ourselves from commodity dependence.
How much has it de-risked ever since you joined? I remember over 60% of your revenues would come from...
I think there's been a significant de-risking, and we still want to continue the journey. And I keep on saying that my aspiration or ambition is that we do an analyst call 3-4 years from now where copra is not discussed.
Okay, that's an interesting one. So how much do you think have you decommodified your business? Not just copra, but even edible oils?
Yeah, so as far as edible oil is concerned, I think what we have said is that the growth of the Saffola master brand has to be through foods.
Yes.
And again, in foods, we are cherry picking categories which have higher margins. I mean, there's always a temptation to get into things like rice, pulses and spices and all, which will give me quick growth. Yes. But we have resisted the temptation to do that because I think one of the things we said that a food business should be far more margin accretive. And maybe 3 years from now, food will be bigger than edible oil in the Saffola.
50-50 was your target, I remember. Where does that number stand right now?
It's still around 30-70, 35-65, it hovers around that. But it should be 50-50 very soon. And maybe 3 years from now, we should be a higher food business,
Interesting conversation there. He hopes that in the future, at some point, the conversation does not center around, parachute and the prices over there. We'll slip into a break on the other side. We've got another corporate conversation lined up. Shank Desai of Mastek will join in about the multi-million-dollar contract that they announced yesterday from UK Public Service Department. Welcome back. Let's talk about Mastek now. The company has secured a multi-million-dollar contract from UK Public Service Department with an estimated value of $85 million over a 2-year period. To talk more about it, we have Shank Desai, Vice Chairman and Managing Director at Mastek, now joining in. Mr. Desai, morning, and thank you for joining in. First, tell us a little bit about this recent order win, and there have been a spate of order wins, particularly from UK. What's the current value of your order book?
See, as we expressed it in our press conference, it is around 85 million pounds to be executed over 2 years. It's kind of, in dollars, around 100 million kind of order. And we need to execute it over 2 years. It is digital transformation and managed services. So in a way, it is fairly balanced kind of contract. It will give us one-time revenue as well as continuity in terms of managed services.
What is the value of the one-time component, and when will you accrue it? Will it be in Q4 or will it be next quarter?
No, I think one time itself continues for 2 years because it's a large contract. So it's not that it is to be done in quarter 4 or even next year. It will continue execution, slowly tapering off and going to managed services, obviously.
So what is the component of the one-time revenue which is spread over 2 years?
Sorry, couldn't get your question, Rima.
So what is the amount that is spread over 2 years, and what is the amount which is managed services which will keep accruing slowly after 2 years?
No, this particular 85 million pound is including managed services in that 2-year period too. There will be a continuity beyond 2 years as we execute this project well. But I can't give you a breakup between managed services and one-time project execution. It will evolve as we go along. It's a project of a national importance, and it's something that we have to execute well, and we are very happy that we got it. We have been doing such projects, as you know, in UK of national importance, and that shows the confidence of our customers in executing large projects, long-term projects, and it's a hard work of many years that we are in this business, last 20 years, in fact. So this is about Mastek's ability to deliver mission-critical large systems, which are very important in coming years. We have to execute AI and other projects. So that is a benefit that we get, and we feel good about it. It is also in AWS area, so we have been moving very big way in terms of partnerships, and this gives us a great capability in terms of executing large projects in AWS, and we'll be one of the major players there.
Got it. So how was Q4 shaped up for you? Because Q3 was a tough one. There were extended furloughs. Q4, what kind of a growth quarter is it going to be for you?
See, Q3, yes, in revenue terms, you are right. However, you must look at 22% increase in year-on-year profits, 16.5% increase in EBITDA, almost 20% increase in healthcare part. So there have been a lot of positives there which are not being noticed. What really happens, Rima, is we are in the business of such projects also. Some of them don't turn up in that quarter, some of the execution gets support. So I would like to really look at it on year because that gives a better feel of what we do. As far as quarter 4 goes, sorry.
Yeah. Please go ahead, sir.
Yeah, so the quarter 4 goes, we have said that we would like to move in the direction of growth, and we would not like to comment specifically, as you know, we are not giving any guidance per se, but this kind of projects execution does give us a better visibility, hopefully.
Okay, all right. Hi, Mr. Desai. Good morning and good to see you. And since you like to look at it on an annual basis for FY26, can you grow in double digits?
See, Nigel, I think we should look at it. You have been in industry for many years on CNBC. We look at it the longer term aspects. If you look at last 4 years data from 1920, just 2021, just before COVID started, and now, we grew 18%. We almost doubled in last 4 years, which is 18% growth, as you know. Whereas industry grew at around 11-12% in rupee terms. We would like to continue that kind of movement where we grow faster than the industry next year. This year also, hopefully, we may be able to do that. So I would not give guidance other than saying that we would like to exceed industry kind of overall industry growth.
UK is about 57% of your revenues, and that's doing well. The one order we spoke about right now, 85 million pounds. But even prior to that, there was a $40 million win from an existing client and a $10 million new one from the UK government. Will UK outperform the company's growth averages? Can UK grow in double digits? Do you have that kind of confidence?
See, what happens, Rima, really is these are large projects, so they get noticed, obviously. in US and other geographies, projects are not of that size. We continue to get large orders, even those countries, like in US, we book 5 million order, we may not get it published all over the place, but there are multiple such orders. So the point I'm making is, we are growing also in other geographies, particularly in US, because of our positioning in particularly Oracle. As you know, we were one of the top 5 rated globally by one of the analysts last year. 5 globally cloud implementation of Oracle. 3 of them were from outside. 3 of them were of Indian origin, 2 were from outside, without naming all of them. But Mastek was one of them. So we have such positioning in US, which gives us a good headway in multiple sectors like healthcare, education, so on and so forth. In Salesforce and customer experience, we have acquired this company, as you know, which gives us declared into healthcare, particularly in government. So we are confident that we may not see a difference in terms of growth. Yes, there can be some plus minuses across sectors, but we see a growth coming all around.
By the way, the Nifty IT index is the worst performing sector today, 3.5% lower for the Nifty IT index. And this year, it's down close to about 13.5%. So after growing at more than 20%, 25% over the last 2 years, 2023 and 2024, IT has started 2025 on the back foot, underperforming, maybe some, NVIDIA hangover. But Mr. Desai, is there any fear of a tax on services which could negatively impact Indian IT companies? And given the general tariff overhang, what are corporate conversations like? What are clients? Is there that fear of uncertainty? Is it delaying decision-making, deal signings, deal conversions?
We have not seen a lot of delays, Rima, in terms of deal signing. But coming back to your important question on tariffs on services, now that's really a slippery area. You see, there is no clarity on how do you charge tariffs on services, because services offers in all kinds of things, as you know. It includes banking services, consulting services, like what we do. So as of now, the focus is only on trade, which is very well definable movement of products. The services move along, telecom lines, as we all do in offshore, and then there is this movement of banking services and so on and so forth. So I'm not really worried about services getting some kind of tariff, because it is extremely difficult to first define and then implement both ways. So I kind of feel that it may not happen, but let's see what as it comes across.
Okay.
But it's going to be
No, absolutely. We just hope it doesn't happen, not just for IT services, but even as someone was pointing out, IT services is one thing for India and it's very important, but even GCCs, right? I mean, they are essentially the growth driver now in terms of services exports. And one just hopes that all of that stays out of the ambit of whatever is being discussed right now and will be discussed in the future.
See, what happens really is that we are not charging any tariff on services coming from outside India. So if it is going to be reciprocal tariff, then it better be same, right? Even if I go by that logic. So,
who knows, sir? I mean, the basic logic seems to be Meri Marzi,
I know.
But we'll see. Thank you very much for joining us. It's a pleasure having you with us, and I hope look forward to our next one.
It's always a pleasure to be on
Thank you.
CNBC.
Thanks very much. Well, let's focus on the real estate picture now. Tier 1 residential sales have seen a pickup, did see a pickup in 24, but the question is, are things starting to slow down a little bit? I mean, this is a topic we picked up about 2 months back. And this is essentially when the markets had started to weaken a little bit. I remember speaking with companies like Signature Global and others and asking them whether the dull price action, at that point dull, now of course pretty severe on the downside, is going to start to show up in real estate sales as well. So let's revisit that topic now. Rajat Kathuria is CEO at Signature Global. Niranjan Hiranandani is chairman of the Hiranandani Group as well. Gentlemen, great to have both of you. Thank you very much for joining us. Prashant this side. Mr. Hiranandani, that question to you, sir, first. Are we starting to see the negative wealth impact with regards to equity markets show up in real estate sales, sir?
Prashant, the reverse is true. We are seeing a 10 to 12% growth in volumes. That has already happened across the board. And I think that's a positive story in terms of the real estate growth as you see. What is worrisome, Prashant, is not about the growth of real estate, but the growth of affordable housing. That's a negative. Look at the ideas and numbers, because you talk about numbers quite a lot on your screen. In 2020, the affordable housing segment was 40% of total demand. Today, that is less than 20%. So you can see what is the growth. So in spite of a 10 to 15% annualized growth in the last 4 or 5 years, you have seen a downward trend in terms of affordable housing growth. And I think that's the biggest challenge as far as India is concerned. We also are seeing the luxury segment and the mid segment grow faster. So you're going to see a growth of 10 to 15% growth annualized over there. But of course, there are sectoral setbacks. So you do see certain areas in the country where the growth story is not as strong, especially where the infrastructure is not so good, or the traffic issues are not being sorted, or there are environmental issues which are being challenged. So yes, I mean, I'm talking about an average growth through the country. So overall, Prashant, I can tell you this year equally will see a 10% growth in terms of volumes of this thing. My challenge has been the government's trying to do taxation, which is far beyond the thing. Let's take Mumbai, for example, as an example. 50% of the cost of my flat in the redevelopment property that I'm doing goes to government directly and indirectly. So there is land under construction, development charge, additional FSI cost, all the rest of it put together comes to GST, stamp duty, etc., comes to about 50% of the total value of the flat. Now, with the ready reckoner rate again slated to go up in Mumbai and Maharashtra, you will see further deterioration in terms of affordable housing taking place. So government actually has actually decided to collect more funds and more taxes and more development charges from real estate. So while on one side housing is growing, the volume is growing, numbers are growing, prices are going up, but on the other hand, affordable housing is becoming a bigger challenge in the country. And I think that is an issue which government is not able to address in spite of the Prime Minister's Awaaz Yojana.
No, absolutely. The question is, if the stock markets remain like this, on a lighter note, you know, those looking to buy premium will have to go affordable. I don't know. But
Prashant, it doesn't, Prashant, as it stands just now, it's not happening. I can tell you that much on the ground.
So you're saying there is no impact whatsoever, even marginal impact of the markets being depressed? Because especially in a city like Mumbai,
Prashant, is the reverse. It's actually reverse. It's going up. People are moving from the stock market into the real estate market.
That is what we had Mr. Abhinandan Lodha with us here, and he made 2 months back. He made the point. He said there is one wave which is he thought, and maybe it's happened back then. He said, well, which will move out of equities and move into real estate. So he was kind of making that sort of point, and he agrees with you. I guess. Rajat, come in here in your market, NCR, Gurgaon. Again, I mean, my question is with regards to how stock markets are doing, and whether there is. I think you did tell us last time that it is maybe at the margin the velocity, sales velocity is slowing down. Go on.
Yeah, hi Prashant. Good morning. So Prashant, this is real estate tends to be a very localized micro market driven business. What we are witnessing in Gurgaon is that while urbanization trends are strong across the country, I think Gurgaon specifically, as far as the NCR market is concerned, has seen very strong migration trends from other parts of the region into people moving into Gurgaon for a variety of reasons. And, you know, we've been quite, I would say, up to tapping this particular opportunity. So the trend, by and large, is that the price rise, which saw very, sharp spike about, 1.5 years ago, price rise has moderated while it still continues to go up because there is still a lack of good quality homes which are available to customers. Hence, price continues to go up, but at a moderated pace. But transaction volumes are steady. So I agree with Mr. Hiranandani that volumes are staying steady, and we are not seeing any sort of decline in transaction volumes as of now.
Okay, not seeing any decline in transaction volumes as of now. That's good to hear then. Mr. Hiranandani, in the city of Mumbai, right, which is where you operate, how is there's so much supply which is coming up? I remember we had one of the consultants on the program, and he gave us a figure, and this is in the premium end, between 15 crores to about 40 crores, and if you have that number to weigh in, we have enough supply which is coming up for the next many years in the city of Mumbai. So supply essentially, according to him, will overwhelm demand in that product category. Just come in there, Mr. Hiranandani.
Prashant, I cannot vouch for the future. I can only tell you what the present demand is. The present demand is enormous. So there is no shortage of demand as it stands today. Number two, you have to see very clearly what is happening in terms of total numbers. So while the total volume of real estate has gone up, while the stamp duty collections have gone up, while realization of GST has gone up, the total number of apartments being sold has come down. That is the challenge. And that is on the affordable side, Mr. Hiranandani, right? Yeah, so that's why the overall. But
affordable,
why we are seeing,
for the last few years, sir, there has been no momentum in affordable at all. We've spoken with lenders who've told us that, I think Rajat, who runs Signature, who's with you now, he's moved from the affordable side to premium because there is no, there wasn't very much demand. But that, I think, also was a function of the, premiumization, booming markets, and that's why I started with that question, sir. Go on, Mr. Hiranandani.
Prashant, I beg to disagree with you. Even in the cases of Panvel, where we operate in a very large way, the demand for 2-bedroom and 3-bedroom is much, much, much higher than the 1-bedroom that we are seeing. And we are also seeing that this upgradation which people want, people are looking at larger apartments and other luxury items which are to be added, even in the other cases. So similar to what you have, that the premium cars are being sold better than the other, which is the lowest value models, which is contrary to what the market expected it to happen. Similar is taking place in the real estate sector. So what you're seeing in the automobile sector, we are seeing it in the real estate sector, and government is actually responsible for it because they're constantly increasing the taxes in terms of land, the value of land, the ready reckoner rates, which actually forces you to sell at higher prices and other things, even in the case of land. So affordable housing is getting pushed out of the market. So it's not only developers who are doing it or the market is doing it, you're also creating a large amount of affordable housing to become unaffordable automatically by way of taxation. So both the reasons are there. One, the market side in terms of the visualization of what the customer is doing, his ability to get loans from the banks at the lower rate, and this rate is coming down. So one from 8.7, it's already down to 8.4, 8.5. I think with the reduction in interest rates which will take place, the EMI will keep on following. So you are going to see much more buyers in terms of housing. But maybe, I don't know about the segments, and I do hope affordable housing takes a pickup also. I'm praying for it.
Okay, all right. Hi, good morning, gentlemen, and welcome to the show. This is Nigel on this side. Mr. Hiranandani, I wanted to ask you about, there's a new player that's going to be coming into the market with cables as well as wires. That's Ultratech. And as of now, you must be sourcing some cement from them. Does it make a difference, if you're sourcing cement from a particular brand? Will you also be looking to take your cables and wires, or do you think the market is good enough, and you'll continue with the current relationships that you have? Just want to understand from a stock market perspective, because a lot of these cables and wires players are very nervous yesterday from a pricing perspective, as we have a new player that's coming in the next 2 years or so. Your take.
every market is challenged by new players. So there is nothing new about it. We have seen new people in terms of supply of materials every time and everywhere. So yes, there will be a challenge to the market in terms of it. Just like new players in the real estate market will make a difference, new players in every market is going to certainly make a difference. And I would look at the challenges as a real challenge. So you will see new suppliers of materials. We already do. We resource different materials from different suppliers, and new suppliers do come up with innovative products at very, very competitive rates. Incidentally, the overall prices have actually gone up, whether it's cement, steel, or others in the last 5 years. So anybody new coming in will actually get an entry level. Definitely, whether they are able to sustain the competitive prices or not, I don't know. But you can see the profitability in terms of the companies which are taking place and the bottom line of the company.
In fact, it could be good news for you because you all will have more amount of suppliers, and in fact, you could get competitive rates as well. So better news for real estate players. You have higher amount of cables and wires players.
No. Wait. Land is the biggest problem. Approvals are a big problem. The cost of development charges is a big problem. The ease of doing business in real estate is getting worse, not better.
All right. I think, Mr. Hiranandani, impassioned plea. And I hope the government is listening, authorities are listening, sir. So you make some very, very strong and forceful points. And I really hope authorities listen to you. Rajat and Mr. Hiranandani, thank you very much.
You're wishing, I'm praying.
Please do. And we'll connect on this topic soon again. Thanks very much for joining us with that sort of status check in terms of real estate sales, both here in Mumbai and NCR, two of the highest value, highest volume, and probably the largest sort of real estate markets in the country as well. We'll take a quick commercial break. I mean, with news, of course, that the markets have gotten a little worse off. 300 points down now, 22,240. We'll get you a quick price action check in just a bit. Stay with us.
Welcome back. 22,250 on the Nifty, down 300 points on the Nifty. Sensex lower by 1,000 points. We started trade down 200 on the Nifty and now we're down 300 points. But look at the advance decline ratio. One stock advancing for 12 stocks declining. We've got about 23 stocks currently in the red for less than 200 in the green right now. So that's, the picture in the broader markets.
I just want to point out two names, right? Just tells you the kind of market we're in. If you can have IndusInd Bank up, it is down sharply because I think there's a weight change, right? As you
there is a weight
down.
up.
Weight up. But
despite that, it's down 5%.
But the point also is it had bounced to about 1,100, 1,150 rupees recently. It's back down under 1,000 rupees now. Look at credit access. We should put that up. It was up 10%. It closed up 10%. It's down 7%. Basically, you can. It's the market where there is just simply more supply as compared to demand out there. So even as there's a positive news flow on the back of it, maybe the stock should be bid up on that particular day. It's not lasting. There is supply which is eventually overwhelming demand. So unless you have time on your side over and you're willing to hold on to some of these positions, I think that is the basic number one requirement in a market like this. Don't try to trade a market where the trend is turned, at least for now, on the way down, because there will be supply. And that, I think, is very, very clear from the price action on some of these names that we're seeing. Nagaraj Sethi is with us, Senior Technical Analyst at HDFC Securities. Nagaraj, good to have you with us here. Thank you for your time. 22,250 now, Nagaraj. Where do supports lie and what's the trade, if there is one, at least on indices?
Been in a sharp downtrend, no doubt about that. On the charts, the opening downside gaps are forming without fulfilling in the near term, and this is indicating that more pain is likely for the Nifty in the near term. So recently, the important support of 22,400 has been broken on the downside. Now Nifty is trading around 22,250 levels. I think the next support would be around 21,800 to 21,900 level, which is the logical support. The important swing lows of last year, February, March, and April during that period. And Prashant, the nature of the market is like the way market has been coming down. Finding the support is going to be very tricky because the strength of a downtrend indicates that important supports gets broken easily on the downside and smaller resistance are kept aside. That's what exactly happening, and I'm expecting a further weakness in Nifty towards 21,900 to 800 levels in the near term.
Okay, headed down towards 21,800. What about any stocks? Nagraj?
Yeah, yes, Rima, I have two stocks from a short side. In fact, one is from a IT side. Tech Mahindra has been in a downtrend over the last 4-5 sessions, and recently below the 200 DMA, the downside momentum has been accelerated. Currently trading around 1515 odd levels. One can look to sell at this point of time, and the downside target would be around the 1440, 1445, and one can place a stop loss at 1550. And the second one is from a Granules. Granules has been in a range-bound action recently. Today, it has witnessed a decisive downside breakout with a gap-down opening. The overall trend setup chart pattern is looking negative. I'm expecting more decline in Granules. Currently trading around 473. One can look to sell at this point of time. And the immediate downside target would be around 450. And one can place a stop loss of around 490.
Okay, all right, Nagaraj, we'll leave it there for now, and we'll come back and speak again soon. We'll take a quick commercial break here as well, with news that it's a sobering Friday morning, 300 points lower on the index. Our special segment, it's the economy coming up next. Third quarter GDP data is due this evening. What should we expect from the numbers? And how's India's macro picture shaping up? Lata will be in conversation with Suvadeep Rakshit of Kotak Institutional Equities and Upasana Chachra of Morgan Stanley. Stay tuned.
Welcome back. Somber morning. And now the all-important GDP number for the third quarter, that is October-December 2024 quarter, comes out today. I say it's all-important because we have to embrace the fact that Indian stocks have been falling, not just because of the global tariff turmoil or US exceptionalism, but also because India is seen to have lost its growth momentum. The second quarter GDP of 5.4 and the second quarter corporate earnings growth below 5% has rattled investors. Funds coming into emerging markets are preferring China over India, given the worries over India's growth. All this makes today's number very important. The CNBC-TV18 poll sees the GDP for October-December to have grown 6.2%. But let us ask the experts who have joined us. Upasana Chachra, the economist, India economist from Morgan Stanley, and Suodip Rakshit of Kotak Bank. Suodip, Upasana, thank you very much indeed for joining us. You know, both of you have numbers below my poll, and I thought my poll was very low at 6.2. Okay, let me start with you, Upasana. Only 6%, right, is your number. What are you seeing as the key weaknesses?
Yes, Lata, we are tracking GDP growth at 6% for December quarter, but the GVA, which is the growth through the industry agri services segment, will be higher at 6.2. So there is a rebound from the September quarter levels, and there will be support that we see growth gets from agriculture, some improvement in manufacturing, and pick up in government spending, while consumption we expect will be more or less sort of steady versus the previous quarter. In terms of drags, I don't think I'll call it as a drag on growth. It's just that growth recovery has been a tad weaker than what we were also probably anticipating while we were in the December quarter. The recovery in manufacturing segment and also the pickup in government capex spending especially has been a little back-ended. And that's why I think the growth numbers for December or our estimates are a little lower than where consensus is pegging it at.
Well, likewise for you, Suodip. Well, I thought the government came in and spent with a bang in December. It overturned the capex fall. As well, construction picked up a lot. Bombay seems to give you that impression. So, you know, if agriculture, construction, government is good enough, it still doesn't pull it up to a 6.3 or something closer to the RBI number?
So I think, Upasana pointed out two numbers, 6.2 and 6%. And let me just dwell upon that fact. We have a number of around 6.4, 6.5% on the GVA and a much lower number on GDP. Just to understand on the GVA front, you have the manufacturing sector, which has been boosted by a decent pickup. And I'm comparing it with the second quarter number. A decent pickup in the corporate profit, especially from the larger contributors such as petroleum products, automobiles, metals, chemicals, etc. Now, that's a pickup in the profit growth, which will kind of reflect on the manufacturing side when we look at it from the GVA. Agri sector growth should be stronger, given that the first advance estimate for the Kharif production has been on the stronger side. Construction sector, as you pointed out, if you look at the steel production, steel consumption, or the cement production trends, that has been has a decent pickup. Also, the pickup in the government spending, as you pointed out, also will play a factor. Now, services will be a bit of a mixed bag in my view. The financial sector growth has been hampered to some extent by the slowing credit growth, right? Urban consumption has been muted, as has been pointed out by a number of the companies, and which is also visible in the GST growth in that quarter, slowing down towards a single-digit number. And that would weigh on the wholesale and retail trade to a great extent. So a GVA growth possible around that 6.5% handle. And also we have to assume that the bases are not changing, because if you recall, the bases were changed by 30-40 basis points, and we had all the revisions which were moving higher. Now, the bigger question is on the GDP estimates. Now, if you look at the subsidies payout, and we have limited information when we are looking at these numbers, subsidies payout growth has outpaced the indirect taxes growth, right? That should lead to a negative gap. My view is that it should be roughly around a 30 to 40 bips of gap that you should see at least between the GDP and GVA. Of course, we'll see what the actuals are. So hence, even if GVA is towards closer to a 6.5% handle, let's say 6.4, I would expect a 6% on the GDP growth. in terms of the gap.
Subsidies payout was higher, you're saying?
Yeah, subsidies growth was higher. So last year, the payout
last year was a big fall. Yeah, fair enough.
Yeah.
So that's going to come back to bite. Upasana, anything on the from the expenditure side that you would watch out for, either private consumption or gross fixed capital formation? I thought net exports would be a decent number, wouldn't it?
So on the GDP by expenditure side, I think if we look at the key to watch would be consumption, given the share in GDP. Consumption, though, I think will have a sort of steady trend, as Sudeep also mentioned. Urban consumption in the last quarter was muted, but we are seeing signs of pickup on rural, or rather rural sort of sustaining some improvement that has happened in the last few months and is building up with the improvement in the kharif or summer crop production as well. So I think consumption supported by rural demand, but urban being a drag, and therefore we see that steady. Capex, I think, will pick up. So yes, as you mentioned, December monthly number for government capex was stellar, 3 times higher versus the average run rate of spending in April to November in terms of INR billion. Pick up in manufacturing related sector profits as well, which should sort of correlate with improved capex on the expenditure side. And on net exports, I think it'll be probably a mixed bag. We are seeing pickup in the services trade surplus.
Exactly.
While merchandise trade deficit was, impacted by the revisions as well, but has been a little higher in the December quarter. So I think current account, if you just balance it out with the current account deficit number, that would probably be making it sort of steady, in my view, in terms of net exports for the December quarter. I don't think it'll be a big boost to GDP numbers.
What is the exact consumption number you're going with? Gross? I mean personal final consumption expenditure.
Yes, so I think private final consumption, I'll keep it steady with September quarter. Again, minus any revisions to the base in terms of YOY. Government consumption, yes, probably some pickup given the government spending has picked up.
Okay. Rakshit, train our eyes. What should we watch out for when the numbers come?
See, a couple of things. I think, so first of all, there are 3 data points that will be coming out. And I'm calling them data points, so they are data releases. One is the third quarter GDP GVA print.
Yeah.
Within that, we need to watch out for what's happening in manufacturing services. Agriculture should be good. Second, we would be looking for is on the consumption versus investment. What is moving, what is not. That's on the third quarter print. And what kind of a pickup are we seeing from the second quarter base? The second part is we are going to get the advance or the second advance estimates for FY25, which was pegged at 6.4%. We'll have to see, depending on the third quarter numbers, as well as the revisions for the past years and the first and the second quarter numbers, where we are standing in terms of the FY25 numbers, right? Whether we are, or whether the government is looking at a further acceleration towards upwards of 6.5% or lower, right? Our number for FY25, based on what we have right now, is around 6.1%. Right.
Oh.
So that's where we are in terms of because of the GDP numbers that we have of third quarter at around 6%, and a slight pickup in the second in the fourth quarter.
Okay.
Now, the third part is in terms of the revised estimates on the FY24 numbers, and within that, I think we broadly know the numbers. What's important is we'll get the numbers on the savings and the investment. So what's the savings rate? What's the investment rate? We know the gap, which is your current account deficit, which is 0.7% of GDP. So not much change is expected on the savings and the investment front compared to past years. However, important to note the number and the breakup where we are talking about, what the private sector is saving and investing, or the household is saving and investing, and the government too.
Okay. Well, fair point. And this is something which I hope viewers take on board, that we are going to get the first revised estimate of FY24 and the second revised estimate of FY23. And any change in the base numbers can impact the numbers, which led one former Reserve Bank governor, Y.V. Reddy, to quip that central bankers in all countries, are impacted because the future is uncertain. In India, the past is also uncertain. So we are going to face, any big changes. Upasana, are you at all convinced that we have seen the bottom of the growth pace and that FY26 promises to be much better?
See, I think from the December quarter numbers itself that we'll get later today, probably that will come as a reassurance that growth made a trough in the September quarter itself. And, we've had this discussion with Subhadeep has mentioned about the gap between GVA and GDP. And therefore, the underlying growth momentum, if we were to track through the GVA measure, which is also a more stable sort of a data set when you're looking at growth rates for India, will indicate that as well, that, there is a pickup in agriculture growth, there is a pickup in industry, and services is sort of holding its ground with some sort of mixed trends within the sub-segments within services. So I think trough, yes, surely made growth recovery also happening. For fiscal 26, our numbers are at 6.5% currently. We do think that domestic demand should be able to offset the risks that we currently see from external demand. I'll just mention, I think there are probably 3 drivers to growth that we
Oh, sorry, the video froze. But I guess we know the drivers to growth. It is private consumption. Hopefully the budget has spurred it. And there are, of course, rate cuts and easing, liquidity easing, regulatory easing by the Reserve Bank. Unfortunately, out of time. Subhadeep, just 2 numbers. What is your Q4 number and what is your FY26 number? Just the numbers, please, out of time.
Q4 would be closer to 6.4% and FY26 we are, as of now, 6.4%.
Okay, so 6.4, 6.5, hopefully the worst is over. But today's numbers are very, very crucial if you want to put behind the feeling that India's growth momentum is gone. Wrap up on Bazaar, chart process coming.